Welcome to the Raise and Exit podcast. This is the podcast for entrepreneurs and business owners who want to get a head start on knowing what it takes to successfully raise their next round or set their business up for a successful exit. It is filled with wisdom from people who've been through this before, people who've gone and raised their own funds, venture capitalists, family offices, private equity, and folks that know what it is to serve through these transactions on a day-to-day basis. Please join us multiple times per week and on bi-weekly retrospectives to get that insight as we share from our own professional experience and that of the wisdom of the crowds to have you achieve your successful raise and exit. On the show today, we have Itamar Novick, who is able to provide a perspective that is rare in the area of VC. He's been named 3 times the Business Insider Top 100 Seed Investor, and we ran our numbers. He is beating the top quartile. So if you're able to get a check from this guy, you might have done something right. So on that note, why don't you introduce yourself a little bit more in your own words so that the people that are listening or watching can get a sense of who you are and why you're here today.
First of all, thanks for having me. I'm so excited to be here because also the topics that you're covering for entrepreneurs are obviously really, really important around fundraising and valuation and how to get your company going from a financing standpoint. So really excited to be here today. My name is Itamar Novick, and I've been in startups for my entire career, which is 25 years. I'm a repeat entrepreneur and startup executive. My last company called Life 360 is now publicly traded on the NASDAQ. It's over a $4 billion market cap. And I've done a series of roles in startups across engineering, product, and business roles. I'm also an investor. I started my career on Sand Hill Road, and have been both institutional Sand Hill VC. I started an accelerator called Upwest Labs, which used to bring Israeli companies. The Bay Area sort of accelerated them. And I've been investing out of Recursive Ventures over the last 12 years. Overall, I've invested in over 170 companies in my portfolio and have been very fortunate to support 2 decacorns and 5 unicorns from as early as inception.
That is an amazing track record, and I think this is a catalyst for why people may want to go and say, I'm going to go and approach your fund. But I think what's also different is actually how you've gone and set your fund up. You don't have a team of people or a board that you're going through to go and get 6 check marks or something like that. Why don't you just tell me a little bit about your philosophy and why you are somebody who can make a decision potentially in a day if the data is right?
So that is correct. Thank you for pointing that. I'm what's called a solo capitalist. So the investment team, yeah, you're looking at it. That's me. And I believe that me and folks like me, solo capitalists, have the best product or service for super early stage founders, especially serial entrepreneurs. So if you're starting a company and you're at the friends and family or pre-seed stage or even early seed stage, I think folks like me who have been in the founder's shoes, been at the same place that you are today as a founder. 1, 2 is are unhindered by VC firm politics. I mean, why would an enterprise GP shoot down a consumer deal they have no clue about just because of whatever political politics that's happening in a bigger venture fund? That's the second thing. And the third thing, I think it's really around mindset, right? So I come into startups with a highly entrepreneurial mindset. Just to give you an example. If one of my founders calls me up and says, Itamar, we know like you invested in this company and this idea, but actually we're going to pivot and we're going to do something else. For a lot of the sort of more later stage or even early stage VCs, that's a really scary notion, right? Like a company pivoting. For me, when one of my companies pivots, I'm dancing on rooftops. I'm like, this is great. They've learned something very important about their market, about their customers, about their product, and now they're actually pursuing the right strategy. So I think in order to best support these very, very early stage startups, what you need is solo capitalists like me and not the big venture firms to kind of back you early on in the journey.
I think what you're also going and pointing to is, I would say, almost in the generalization of how we go and look at venture capital. Venture capital really has fundamental stages in it, right? And there's the whole notion of, hey, we have an idea. We think that there's a market need. And you want to be able to go and validate it. And I call that almost pre-product market fit. This is like a opportunity or, challenge that needs to be solved fit that's there. So tell me a little bit about how you would kind of unpack that stage that you invest at, which is more at the seed level, and call it early pre-traction, pre the typical metrics that I think get sensationalized, versus the post-seed, which it sounds like you might go and cut a second check to support things, and at times you have. What's the difference in mentality that a founder or an entrepreneur should know about how venture works?
Absolutely. So me and my founders, we're in the business of finding product market fit. One, and two is making sure that we don't die because we run out of money while we're looking for that product market fit. That's really the business that we're at. This is the very early innings of startups, right? Again, friends and family, pre-seed, seed, whatever you want to call it. But essentially, and obviously there's different stages that the company can go through, and different verticals also have different set of challenges. You're building a cybersecurity company, that's very different from building a consumer company, right? So I think what characterizes a lot of the work that I do at Recursive Ventures is really supporting founders in those earlier stages where, you know what, a lot of the questions that bigger VCs, Series A VCs would ask don't really have an answer for yet. Like we don't know yet. We're trying to figure it out. Well, if you look more traditionally at the sort of cutoff between what I call super early stage and
Yeah.
early stage investing, it's probably when you have some repeatable, scalable product market fit, and it doesn't have to be 100% fit. So you can really bring in a Series A round where you would actually sort of earmark the majority of the capital for scaling up the operations, right? We have a product, we know how to sell it. Now we need to rinse and repeat that sales motion is sort of the stereotypical Series A deals. And that's almost like too late for what I do. I'm the guy that helps the founders get to that stage first.
Okay. So I want to build on what you just gone and said there, because there are people that are almost like serial founders. They're very good at identifying the opportunity. They can kind of see the signal from the noise earlier. What do you notice are some of the struggles that are there that founders experience when they transition from seed to more of that Series A or Series B, when you're more of a business versus an idea hunter?
Wow, that's a great question. So let me just jump in and say that a company goes through a life cycle, startups go through life cycles where there are several significant breaking points that require different founder mindset,
Mhm.
different different types of employees potentially, right? And a different operational cadence. The stages that I typically invest in companies, they're characterized by a bunch of founders running around with early founding team members who are um, they can take on risks. They feel comfortable with uncertainty, right? And they're there to explore and figure it out how to wide open this market, right? uh, and then on the founder side, the founders that we're looking for, right, that people like me and myself I'm looking for, are founders that can go all the way from writing code day one, or at least helping out with writing that code, to running a public company, which is honestly insane. It requires
Mhm.
so many different skill sets, right? Between like figuring product market fit early on, raising money from pre-seed VCs, to managing your board and scaling up your executive team with the best executives in the world to take a company public. So those are the type of unicorn founders that we're looking for. And really what happens for these founders is they go through this journey, right? Even repeat entrepreneurs, and obviously people that haven't done before, they go through this journey of really learning and
Yeah.
growing significantly to deal with the different challenges that those different stages have. Just philosophically, the breakpoints that I was talking about initially, they happen at certain milestones. So somewhere between 50 to 25, 30 employees, we see a breakpoint. We see another breakpoint between 50, 60 to 80 employees, and then again. Those breakpoints happen when you had another layer of management into the company's culture. And that's where you have to shift the culture, shift the conversation, adapt to this new paradigm that your company now lives in to be successful as a founder, as an executive team, and even as an investor in these companies.
Yeah, it's interesting what you go and point to, because I would almost go and interpret what you're saying that you need somebody who is thirsty for knowledge, has a certain bit of humility in that they don't know yet what they need to know to take this company to the next level. And then they have to have an ego.
Right. And they have to be smart enough, right, and charismatic enough to carry this thing forward when it's kind of mutating so quickly, in front of their eyes.
So I'm going to go into like two questions right in the same domain around this piece. Okay. What is a question that you always want answered when you're going and saying, I'm going to invest into this person or this team? Because if I really take a look at how you're not investing into companies, you're investing into people.
Correct.
So what are you going and wanting to always get answered? And it may not be answered by the founder. It might be something you ask of yourself. What's something you want to get answered?
So I've actually systemized parts of this. And I have a process where, me and my advisors fill up scorecards specifically in regards to the founding team and the talent around that. So I'll just kind of steer this conversation more toward what we're looking for with founders. And I'd say, we're looking for completeness, which means we want to see the main pillars of the business embedded in the founding team today, right? Can they build? Can they sell? Do they complete each other? So completeness is one piece. The second piece, which is actually decreasing in importance in the era of AI bootstrapping and seed strapping, is what I call fundability. Are
Mhm.
these people fundable? Would they be able to raise subsequent funding rounds? Can they kind of sell this vision to the broader world and more specifically to investors? So that's the second thing. The third thing that I look for is, and it's not mandatory, but it's very important, is subject matter expertise, or at least having some unique insight into a market, into a set of problems, into a set of customers, right? And I'd say the last thing that we look for systematically is passion around the problem, not necessarily the solution, um, but passion around, like, why do you really care about this problem? And look, sometimes the answer of, like, I just identify an opportunity and I want to make a bunch of money. It can be sometimes acceptable, really depends on the situation, but mostly I tend to gravitate toward founders that really have a deep passion to solving that problem. The last thing that I'd say, which I've already sort of highlighted, but let me dig in a little bit more, is again, these type of unicorn founders that can go all the way from
Yeah.
starting a company to running it while it's public. Like actually, like my partner at Life 360, Chris Holmes, who started a company and still runs almost a $5 billion public company today and does an amazing job as a CEO. Where do you find those people? So typically, like you said, they are more humble. They are very charismatic. They have significant intellectual interest and curiosity, right? They want to continue to learn. They're student always, right? And they have the intellectual firepower to figure this thing out on all accords, right? Like
Yeah.
people, business, fundraising, market, product, like all those different pieces, right? Which is obviously rare. And that's why we call
So,
them unicorn
so I'm going
founders.
to retract my statement around ego and I'm going to go and replace it with conviction. I think there's a degree of self-conviction, not at the level of arrogance or ego, but at kind of like that intersection of what you're going and talking about. Which brings me to the next point, because as you said, right, your aspiration is to go and find companies, well, let me phrase it, find founders that can go and build companies that can get through all of those stages of a corporate growth. What do you think is something that a founder needs to consider in how to value their idea at the seed stage? What do you see as a responsible understanding of the raise versus an irresponsible understanding of the raise?
Absolutely. I'll point the one that I see, the common mistake that I see most often, which founders do, and I think hurts them more than they appreciate. And that is focusing on the total addressable market. And the reason I think that's very important is if your TAM, after an objective analysis of the opportunity, is not big enough, do not go out there and raise venture capital money because you're inherently misaligned with your VCs. Your VCs, they're investing for the shot for this thing to be a multi-billion-dollar company. And it's not going to be a multi-billion-dollar company unless it can show the path to a significantly large total addressable market, probably in the $5 to $10 billion or more of potential revenue in this market in the next few years, right? And that the thing that founders do, the exercise that they do is they build that TAM slide because obviously all the templates tell them that you have to figure out what the
Yeah.
TAM is and how big the market is and do a bottoms up and do a top down. But they're doing it to sell the narrative to VCs. And I want to flip it on its head. I'm like, I want the founders to get conviction that this opportunity is so big with actual numbers, not just your intuition, that it actually warrants raising venture capital money. Because if it's not, it can still be a great business, but you shouldn't raise money from VCs.
I love what you're saying there because this kind of goes into what I also get involved in a lot, which is unpacking TAM into what portion of it is winnable. And I see a lot of these assumptions as we're going to take a percentage of TAM. But that's actually what I think is the gap in the market. I think a lot of people need to figure out how much of the TAM is at play at any given time and then get to a present value of that next 5 to 10 year time frame that's there. Which kind of
Absolutely.
brings me to the next question that's there. I love seeing all of these coverage of like, oh my gosh, this company went and made it to unicorn, or this company went and raised, huge amount of money at a great valuation, etc. And then you go and find out when they were founded. And it's always like half a decade older than you think it is.
Right.
So that is changing now with the AI enabled or, bootstrapping that's there. But how important is that for a founder to realize how long that grind is versus when they really make that front page of whatever, Silicon Valley chapter of Wired or New York Times?
So actually, let me build on what you said. I think what AI and approaches like vibe coding deliver today is significant velocity in product development. That's actually different than market building and building a brand and a marketing and sales machine in the industry that you're focused on selling into. So yes, we've gone through an era where it's taken 10 to 15 years to take a company from inception to going public, sometimes even more. So this is very long. It's kind of even hard to grasp. I've spent 13 years at Life 360, right?
Yeah.
It's very, very hard to grasp what working, on something for 15 years looks like, right? It's eternity professionally, right? So it's a very long journey. And the contrarian point I'm going to say here is that I think with AI, some of this kind of duration can be compressed a little bit because of acceleration in product development. But I don't think you're going to see the same with market development, in the sense that maybe you're going to shave off a year or two out of this thing, but it's still a 12-year journey, if you ask me.
I love that distinction that you went and put between product development and market development. And I find that that is underappreciated because people are going and looking for that initial traction, right? There's so much guidance out there. Go and find 10 or 30 customers that are going to go and find value, get that initial traction and be able to build it from there. But I kind of go back to Jeffrey Moore's work where he goes and really articulates, look, you got to be able to go and cross the chasm.
Right.
And I think what you're pointing to in that kind of self-articulation of the TAM, is there a critical mass? Is there a moment there in your industry that a chasm is there to be crossed?
Right.
Because I think that's something that people forget. And cybersecurity is an example of it. There's thousands of cybersecurity companies. Nobody has consolidated the industry yet. So that kind of goes and tells
Well,
me,
actually, there is a consolidation happening as
oh,
we
say
speak
more.
within 4 to 5 platforms in cybersecurity. And that's interesting because at the same time, it actually diminishes the opportunities for VCs because it's hard to build another multi-billion-dollar platform in cybersecurity. But your point is very well taken. And that is that, you know, you really have to, you talk about crossing the chasm. I think conceptually, philosophically, that's a really good point, a really good way to think about it. But in practice, what happens is you're selling a bunch of software to people and they have to change how they work today. They got to adopt. You got to drive to customer success with this thing. And it's only going to go as quick as people can go, right? And it will take time for that word to spread and for those users to actually embed these new workflows into the day-to-day lives. And you can only accelerate that so much, right? And sometimes it takes showing up 5 times at that conference and having your logo up there and having that booth until you actually feel the momentum. Whatever,
Yeah.
it doesn't matter how much money you throw at the problem, it doesn't always fix itself that way, right? Sometimes things just have to settle in, and that's part of
I
the go-to-market.
I love what you're saying there because what it's kind of going and having me as a takeaway is how important it is to be able to understand the human condition to be able to even respond to your offer or incentive that's there.
Yeah.
Do a lot of work in identifying challenger brands and categories. And it's amazing to go and see how many people, oh, I wish I could go and buy this company's product on behalf of the organization that I work for. And we're locked in for another 2 years.
That's
Right.
right.
And you got to kind of have that patience, that piece is there.
That's right.
As I come to kind of towards the end of my questions for you, Itamar, one thing I always have a question for people that I in this space is there's a lot of guidance that I've heard of when you start a company, you have to have an exit in mind.
Mm.
Is that wise or is that a crutch?
Yeah, I don't think it's the right mindset. I don't encourage that mindset among my entrepreneurs. I think, again, we're looking at unicorn founders who go all the way. And if you truly have that conviction, that persistence that you also talked about of going all the way, you're not thinking about exits. You're thinking about your vision of how this company is going to look 10 years from now and the kind of impact it's going to have on the entire ecosystem of users and employees and shareholders and so on and so forth. And I think if you're gearing your company toward an exit, then you're probably diluting the opportunity of building, to some degree, building a strong, big independent company that could go public, right? And I'm not saying IPO is the best thing in the world. You know, there's definitely, having gone for one myself, having taken my company public actually as a CFO, there's a lot, there's a lot. It's a very complicated path, but you know, the founders that I've seen being the most successful are the founders that are not focused on exits or liquidity events or making money. They're
Yeah.
focused, they're maniacally focused on building the best product for their customers and making sure their customers are happy. And the rest comes afterwards. So I think that is the mindset that I've seen being more successful. And the people that are focused on exits, but just basically cut their successful journey off earlier on in the cycle.
I love that. So, Itamar, I'm going to put the last word for you. Who is that bold founder or entrepreneur that should go and reach you on your socials or reach out to you direct? What are they investing in? What type of companies are they starting? What type of problems are they solving to come and say, I'd like to get a check from you?
Yeah, so the things I'm most excited about these days are obviously leveraging generative AI and AI to disrupt antiquated businesses and services such as financial services, insurance, and real estate. I'm also a generalist, so I'd look at almost anything AI, but B2B is kind of my bread and butter. I do a little bit of consumer AI, but I think, what I'm excited about is strong founders who have figured out unique markets and a moat in AI, which is obviously very hard. And I would advise those founders to, you know, don't call me. It doesn't work. Find somebody who knows me and knows you and is potentially willing to put in a good word for you and have them reach out on your behalf. That is the best way to engage with me. That is the best way for me to take your business seriously. And that's the right way to do it, because otherwise, I'd be wasting your time. The most valuable resource you have as an entrepreneur is your time. Don't waste it on people that are not serious about your business.
Itamar, that is a wonderful way of closing and giving counsel to that next generation of entrepreneurs, whether you put a check into their company or not. Thank you for your time today and look forward to a future occasion.
Thank you so much for having me. Really enjoyed it.
Cheers. The interview with Itamar was interesting for me because I really had to reflect on the value or frustration that I kind of had on TAM calculations. And to have him go and indicate that, look, you need a big enough TAM to kind of get traction at his stage of investing had me consider that maybe TAM has more value to it than I sometimes go and espouse in some of my other work. Like, look, TAM is a great thing to go and have in large numbers, but I always go and talk with companies around what it takes to get to that TAM at any given point in time. And as he ultimately puts it, from my perspective, is that you need a large enough TAM to go and get that conviction in the absence of a lot of other information. And I think that part is really, really critical is can you articulate that your TAM can be big enough, your total addressable market of consumers, of businesses that you can go and sell to, regardless of whether it's niche space or not. And I also want to kind of highlight the last thing that I take away from this is it's not important to everybody. I think it's so critical for you to understand what are the metrics that are being used by the people that you're wanting to get checks from or you're wanting to have sell your business to that determines how they go and put a value on the business. These things are not universal. You have the spectrum of spray and pray at one end to highly precise, significant due diligence on the other end. And you got to figure out where everybody is along the way. So stay along with us at Raise and Exit, and you'll kind of get a sense of the different spectrums that is there and take advantage of the data set that we're putting together of how to self-evaluate as to how to approach your folks that you know to raising capital or trying to sell your business to. Cheers and have a good day.